Welcome to accounting using logic models. This is a visual approach to obtaining financial insights for both entrepreneurs and students. Let me be clear about the purpose of this course from the very beginning. This is not about merely knowing how to record accounting transactions. Instead, it's about genuine insights into how to make positive value-added decisions that lead to positive economic value being added to your business. Throughout this course, we will explore a fundamentally unique way of understanding finance, one that puts decision-making at the very forefront of everything we do. By the end, you won't just understand the mechanics of accounting, you'll understand why those mechanics matter and how to use them to create real value. Historically, we have assumed that if students understand how to record transactions accurately, it would naturally lead to the business becoming financially sound. But is this really true? Think about it for a moment. Knowing where to put the numbers doesn't automatically mean you understand what those numbers are telling you about your business's health, risks, or its opportunities. But this assumption has shaped how accounting has been taught for generations, but it leaves a critical gap between technical competence and practical business wisdom. My approach addresses this gap directly. History has shown that there is a strong focus in accounting education towards how records should be kept. In my opinion, there should rather be a more dominant focus on what the reports are saying and how one can leverage the system to create more value for the business entity. Here's a sobering reality. Many businesses have failed despite maintaining a strong bottom right-hand corner. What is this bottom right-hand corner? It's that final number on your financial statements, the profit figure that everyone focuses on. But focusing on that number only is like driving while looking at your speedometer only. You might be going fast, but you have no idea if you're heading towards a cliff. We need to look further up the value chain, away from the BR8C. When looking to improve business results. When business flow diagrams have been created, the focus has traditionally been on identifying the individual steps in a process and displaying those accurately. There's nothing inherently wrong with that thought. It does serve its purpose. However, my focus is different. I want to help students and you understand the interrelationship between the steps and how business decisions can increase risks within a business. Equally important is to understand how different decisions can be made to increase value creation and mitigate those risk elements. It's not enough to just know these steps. You need to understand how each of these steps connects to the next and what happens when you change one part of that system. I have created a simple business model that far better illustrates the value flow within a business process, rather than merely illustrating the individual steps that take place in that process. Why is this distinction important? Because when you see the value flowing in the business, you begin to understand where value gets trapped, where it leaks out, and where it can be amplified. This visual representation transforms abstract concepts into something you can genuinely understand and work with. Let's build this understanding from the ground up, starting with the simplest form of a business, a pure cash operation. This 6-bucket flow clearly shows the elements that make up this cash conversion cycle. With this model, you can easily see where the risks lie. But what is this cash conversion cycle? It represents the journey cash takes through your business, from when you pay for materials through production to when you finally receive the payment from your customers. This enables the entrepreneur to more clearly see the financial risks that culminate when making certain business decisions. Each of the 6 buckets represents a stage where cash gets tied up. Understanding this cycle is fundamental to managing working capital effectively. Maintaining the first rule for business survival is a non-negotiable requirement, not only to survive, but also to maintain healthy growth for a business's future. The leaders of a business need to understand these elements thoroughly, and my models clearly show why this is so important. They go far further than merely stating the popular saying, Cash is king. Yes, cash is king. But why? What does that actually mean in practical terms? And more importantly, how do you ensure your business maintains adequate cash flow while pursuing growth opportunities? These are the real questions we'll answer. My models clearly show how the FISO principle comes into play. Many businesses acquire assets at their peril, and often leaders confuse the difference between creating value and owning an asset. What is this FISO principle? It stands for fast in, slow out, referring to how cash behaves when you acquire fixed assets. Money goes in quickly when you make the purchase, but it returns slowly, only when you eventually dispose of the asset. The FISO principle applies to many areas of the business, but it's particularly well illustrated when we examine fixed asset acquisitions and their impact on the working capital. My balance sheet logic model easily illustrates the areas of focus within a business and the broad elements that make this up. It can be broken down into three main elements, which can be expanded upon differently by different businesses. This flexibility is important because no two businesses are identical, yet all share these fundamental building blocks. When you visualize the balance sheet this way, you begin to see it not as a static snapshot, but as a dynamic map of how resources are deployed and controlled within your organization. This lesson is about arguably one of the most famous equations within financial education. Assets equal liabilities plus owner's equity. I have found that this is often treated as an academic exercise undertaken by many students without them realizing its real power. To most, it's simply a way of checking the accuracy of where one must record different transactions. But my imparting of the insights within this simple algebraic equation will change your views of it permanently. The accounting equation isn't just a simple balancing mechanism. It's a fundamental truth about how businesses work and how value is created and distributed. My 10-bucket analysis tool not only enables students to see the important points within a question, but really helps business leaders identify and see where the risks are increasing within a business. Beyond these risk identifications, this tool guides decision makers on the daily choices they face. It provides a visual framework for understanding of where you can improve the value add process. Think of it as a diagnostic tool for business health. Each bucket represents a potential area of concern or an opportunity, and by examining all 10 together, you get a comprehensive view of your organization's financial position. Moving on, we'll explore the turnover logic model. This model is so simple in its nature, yet it's remarkably powerful in the business insights it shares. Many accounting students and business leaders realize only after having gone through this model where their focus should lie within the Statement of Comprehensive Income, or the SOC. This understanding emphasizes why one needs to look further up the value chain, away from the bottom right-hand corner, when looking to improve business results. Revenue is where it all begins. Understanding the characteristics of your turnover, its components, its drivers, its patterns is essential for any meaningful financial analysis. The different characteristics of cost types and their drivers are explored within these models. Not all costs behave in the same way. Some are fixed regardless of your activity level. Others vary directly with the sales or production levels. Understanding these behaviors is crucial for decision making. When you understand the cost drivers, you can predict how your costs will change as your business grows or contracts. This knowledge is invaluable for budgeting, pricing decisions, and strategic planning. The vanity funnel. This logic model illustrates the flow from turnover all the way down to retained income and shows the various profit points within a business entity. But why do I call it a vanity funnel? Because each layer of profit that we calculate and report upon has its own purposes and its limitations. Some business leaders fixate on one profit measure only, while ignoring others that might be more relevant to their actual performance. From gross contribution to net operating profit, from profit before tax to profit after tax, and finally to the retained income. Each stage in this funnel tells a different story about your business. The cash flow statement is another area we will visit. Many students have difficulty in seeing that there are three elements to this report and what these consist of and where they fit into the whole analysis of a business. Formal education has historically often examined the indirect approach to creating this report. However, with the strides made by modern data analysis tools, the emphasis may better be placed on the direct method of creating this report. When this report is combined with the balance sheet logic model, the significance of the cash flow statement becomes much more clearly understood. You begin to see how the operating activities and the investing activities and the financing activities work together to determine your cash position. Why did pioneers like Joel Stern and Goldratt create their analysis systems? With these tools, this can now clearly be visualized, and you can see the value add of their initiatives. Economic value add goes beyond traditional profit measures to ask a fundamental question. Are you earning more than the cost of your capital? This is a true test of whether a business is creating value for its owners or not. Understanding EVA transforms how you think about business performance and investment decisions. Armed with these insights provided from the aforementioned logic models and lessons, the task of analyzing a business entity's results becomes easy to see. Ratios are not just numbers to calculate for an exam, they are diagnostic tools that tell you stories about the business's performance. But those stories only make sense when you understand what the ratio is measuring and why it's measuring it. This is where all our previous learnings comes together, where the logic model framework enables you to interpret ratios with genuine understanding. Before tackling the different ratios, it's important to understand where the focus of each category lies and how these help the business leaders and students understand why and how they illustrate the different areas of the business. We examined 5 categories: profitability ratios, showing how efficiently the company generates profit; turnover ratios, measuring how well assets and working capital are managed; liquidity ratios, assessing the ability to pay short-term debts; debt and solvency ratios, examining financial leverage and long-term stability; and earnings ratios, focusing on shareholder returns and value add. Thereafter, each category's ratios are explored individually. This is the first of my practical models or scenario tools, designed to help students both understand the concepts and experiment with them. The break-even model answers critical questions. Can we survive a downturn? Is the business model viable? How much volume do we need versus what we want? Business leaders will benefit from using these models to help see where the most impact can be gained for their specific business entity. DuPont's model, a working model of one of the most powerful business ratio analysis tools, has been created here, enabling business leaders to leverage and see the results of the decisions they face. The DuPont model breaks down return on equity into its component parts: net profit margin multiplied by asset turnover multiplied by the equity multiplier. This decomposition reveals exactly where improvements can be made. Students can also here visually understand how initiatives that a business undertakes impacts on overall results. It's not just about knowing the formula, it's about understanding what levers you can pull. Operating leverage analysis model. This practical model helps the user see how different business decisions will impact the various profit levels. It illustrates what leverage a particular decision may have on the overall result. Operating leverage shows how sensitive your profits are to changes in the sales volume. High fixed costs means high operating leverage. Great when sales are growing, but extremely dangerous when they're declining. Understanding this relationship is crucial for strategic decision making. The product mix optimization model. Business entities often face the dilemma of which product must get priority. This practical model helps in evaluating these business decisions. The key insight here is that the optimal strategy focuses on contribution per constraint hour and not just margin percentage. Product C, for instance, might have the highest margin at 30%, but if it uses 4 hours per unit, it's not the best choice. Product D, for instance, with the lowest margin at 56.3%, should actually be maximized because it generates the highest contribution per machine hour. Strategy 3 generates 20% more profit than Strategy 1 from the same resources. Critical path analysis is often linked with the improvement of time taken on projects and implementation optimizations. This practical tool helps in evaluating crucial decisions made around project management. It identifies which activities have zero float, meaning any delay directly extends a project duration. Understanding the critical path allows you to focus resources where they matter most and identify opportunities for acceleration. The cash conversion cycle optimization model. This model is the first of its kind as far as I'm aware. It helps the user to see what results can be achieved by changing or optimizing the cash conversion cycle. Importantly, it lets me illustrate why the shortening of the cycle may have an unintended worsening effect on the profits of the business entity. This seems counterintuitive, doesn't it? The ROI analysis section helps determine if a proposed change is worthwhile. Sometimes what appears to be an improvement actually costs more than it gains when you factor in all the capital implications. In today's business environment, it has become imperative that we analyze business improvement initiatives individually and not within the picture of the whole business. Creating financial reports around a project or strategic initiative is no longer a luxury. It requires a paradigm shift in how we compile financial reports. The need to slice and dice a business along different dimensions has become a part of modern business analysis for today's leaders. The cube approach to accounting allows you to examine performance across multiple axes simultaneously, Incoterms and the risk transfers thereon. Often, the transfer of risks within a business transaction is used to determine the timing of an event. Disputes over which party carries the loss when a business event fails to complete often has led to points of contention, especially with the advent of more cross-border transactions. This table illustrates the internationally accepted timing of such events, particularly from the perspective of transferring ownership. It is relied upon heavily in the auditing world. Despite this being the case, business risk may transfer in theory at such interval points. However, in the practical world, this is not always the case. Understanding these distinctions is crucial for international trade. To many business leaders, tax is seen as a necessary liability on successful business transactions. However, this liability does present business leaders with real profit improvement opportunities. Often, seemingly counterintuitive situations present themselves whereby return on equity and return on assets can be improved through careful tax planning. Consider, for example, the sale and leaseback of assets. My apple tree concept asks the question whether assets contribute more to economic value add than the statement of comprehensive income may suggest. This is advanced thinking that separates strategic finance from mere bookkeeping. Thank you for joining me on this journey through logic models. I hope that these visual approaches have transformed how you understand and apply financial concepts. Remember, the goal is not just to know accounting, but how to create this hook.